Welcome, everyone, to this explainer. I want you to picture a modern office environment for a second. You know the kind, financial analysts intensely monitoring these fluctuating markets across a massive array of screens. But what are they actually watching so closely? Well, they're tracking uncontrollable market forces. Literally every single business on the planet, no matter how well run, is exposed to these massive external shifts. So today we're focusing squarely on financial risk management. We're going to decode what we call market risk. We'll look at the exact types of market risk out there, and crucially, how they impact the daily survival and profitability of businesses. It's an absolutely fascinating subject, so let's get right into it.
Okay, let's dive into this roadmap. We'll start off by defining financial risk, then we'll break down the major types: interest rate risk, foreign exchange currency risk, and price and market volatility. Finally, we'll wrap the whole thing up with strategies for risk management. Breaking complex topics down into these logical, structured chunks just makes them so much easier to digest.
Now, before we get too deep into the weeds, I want to point out that this explainer is heavily grounded in professional, real-world frameworks. Specifically, we're drawing on modules like those from the Certified International Risk Manager program. So we aren't just talking about abstract theories today. We are looking at the actual, practical frameworks used by certified professionals to protect global organizations.
Section 1. Defining financial risk, the taxonomy. Because before a treasurer or a financial analyst can even begin to solve for a risk, they absolutely must properly categorize it. You simply can't fight an enemy you haven't identified, right?
So the biggest dividing line in risk taxonomy is between unsystematic and systematic risk. Unsystematic risk is micro. It's stuff that's controllable by the organization. Think of things like an operational failure or a specific legal issue. But what we are focusing on today is systematic risk. This is macro in nature and entirely uncontrollable by a single organization. It's frequently referred to simply as market risk. These are those sweeping factors, like a global recession or a sudden geopolitical event, that impact the entire market simultaneously.
To understand how professionals actually measure this, we have to look back to Harry Markowitz's foundational work in 1952 on modern portfolio theory. He proposed that the variance, or the standard deviation of a portfolio, is the actual mathematical definition of risk. And honestly, this was a massive paradigm shift. It mathematically grounded our modern understanding of financial risk. So risk isn't just some gut feeling, it's the statistical variance of your expected returns.
Moving right along to Section 2, interest rate risk. This is the first specific branch of market risk we're going to examine, and it revolves entirely around the cost of borrowing and the danger of changing interest rates, or their implied volatility.
And this brilliantly illustrates exactly how fluctuating interest rates create tangible opportunity costs in the real world. Imagine a bank issues a 30-year mortgage locked in at a 4% interest rate. Sounds fine, right? But what happens if the overall market interest rate suddenly jumps to 6%? The result is that the bank essentially loses and the consumer wins. That bank is stuck earning just 4% on that capital for 3 decades when they could be earning 6% in the current market. Now, this isn't a direct cash penalty, but it is a massive opportunity cost that drastically affects the bank's profitability.
Section 3. Foreign exchange currency risk. If your business crosses borders, well, this is where things get incredibly volatile. Global trade relies entirely on fluctuating exchange rates, and these shifts can drastically alter the actual value of a company's assets and liabilities literally overnight.
Let's look at how this plays out. Say the euro depreciates against the US dollar. It suddenly takes fewer dollars to buy a euro. The business impact? Well, US exporters take a huge hit because their goods just became much more expensive for European buyers, so demand drops. But conversely, US importers gain. European goods are suddenly way cheaper to bring into the States. This dual-sided price effect shows how a single currency fluctuation creates both winners and losers, depending entirely on which side of the transaction you sit.
Let's make this even more specific with a real-world business scenario. Picture a UK business importing Chinese fabric. The fabric is priced in US dollars, but the UK business sells its final product in British pounds. Furthermore, they have 30-day payment terms with their creditors, and their own prices are fixed monthly. Just think about the exposure here. The currency mismatch between their costs in dollars and their revenue in pounds, combined with that time delay of 30 days, creates massive vulnerability. If the pound drops against the dollar during those 30 days, their profit margin is completely wiped out before they even pay their supplier.
This leads us right into Section 4, price and market volatility. We've talked about interest rates and currency, but market risk also fundamentally arises from equity price risk. Think of stock market charts suddenly dropping and wiping out an investment portfolio. And then there's commodity risk,
where the cost of raw materials like oil, gold, or agricultural products suddenly spikes, directly impacting production and profit margins. Let's rapidly fire off the subtypes here so you can grasp the true breadth of this taxonomy. You have absolute risk, which is just the basic coin flip probability of an asset moving up or down. You have volatility risk, where the danger isn't just the price changing, but the rate of change going totally wild. But pay special attention to basis risk. This is a fascinating one. Basis risk arises from imperfectly matched markets. Imagine a trader tries to mitigate risk by taking offsetting positions in two related markets. If those markets aren't identical and don't move in exact lockstep, that gap, that imperfection, is basis risk.
Let's move to and see how this builds. Up until now, we've spent time identifying the villains of the story, these uncontrollable macroeconomic forces. But businesses don't just sit there and take the hit. Now, we're shifting from the problem to the solution. We are going to look at the active tools and financial instruments used to manage and fight these risks.
Welcome to our final section, Section 5, Strategies for Risk Management. How do corporate treasurers and risk managers actively combat these uncontrollable systematic risks to protect their organizations? Let's take a look. The very first, most fundamental defense mechanism is diversification. Because market risk impacts the entire market, you cannot eliminate it simply by picking a different stock. As we see here, market risk can only be reduced by diversification into assets that are not correlated with the broader market. We're talking about alternative asset classes. If the whole stock market takes a hit due to a recession, a properly diversified treasury might hold alternative assets that don't move in the exact same direction at the exact same time. Another absolutely critical weapon in the risk manager's arsenal is value at risk, or VAR. It gives an organization a concrete number, a mark-to-market loss on a fixed portfolio over a fixed time horizon. Basically, it answers the question, under normal market conditions, what's the most we expect to lose over the next week? However, it is vital to know its limitations. VAR relies purely on market prices. It completely fails to capture massive economic costs that don't show up on a daily financial statement. If a market shock destroys customer confidence or crushes employee morale, VAR won't measure that. It's a powerful monitoring tool for sure, but it is not a crystal ball.
Now, what's really interesting about this slide is the heavy emphasis on intent. A tool is completely useless without a specific strategy. Simply having a generic policy that says, we use FX forwards, is basically meaningless. True risk mitigation requires strict, specific treasury policies. Remember that UK fabric importer we discussed earlier? A proper policy wouldn't just say, hedge the currency. It would say, our aim in hedging our currency risk is to ensure our products can be sold at the exact profit margin we forecast when the purchase was made. Specificity is the armor that protects the business.
So the crucial point here is this massive figure, 80%. This represents a dangerous lack of counterparty limits. A lot of businesses actually fail to put individual limits on the banks they trade with. If one bank offers incredibly keen pricing, you might be tempted to do 80% of your swaps, forwards, and overnight deposits with them. But think about it. If that single bank defaults, your entire business is suddenly in jeopardy. Historically, banks that are about to fail often offer desperate below-market pricing to attract deposits. Chasing a cheap deal by putting 80% of your risk with one institution? That's a catastrophic failure of risk management.
We've covered the taxonomy of financial risk, the specific threats of interest rates and currency fluctuations, the bumps of equity and commodity volatility, and the strategic tools used to fight back. So I want to leave you with this provocative thought. Is your organization's treasury policy truly protecting you from the uncontrollable forces of market risk? Are you genuinely diversified? Do you have strict counterparty limits in place? Take these frameworks and apply them to your own business context. Thank you so much for learning with me today, and I really hope this explainer has empowered you to look at the market with a much sharper, more analytical eye.